Leverage buyout is a complicated acquisition structure that requires the involvement of different parties to ensure a successful transaction. Let's go through some of the key players in effecting a successful transaction. Financial sponsors. The term financial sponsor refers to traditional private equity firms, merchant banking divisions of investment banks, hedge funds and venture capital funds. PE firms, hedge funds, and venture capital funds raise the vast majority of their investment capital from third-party investors, which include public and corporate pension funds, insurance companies, endowments and foundations, sovereign wealth funds, and wealthy families, individuals. Sponsors vary greatly in terms of fund size, focus, and investment strategy. The size of a sponsor's fund, which can range from tens of millions to tens of billions of dollars, helps dictate its investment parameters. Some firms specialize in specific sectors such as industrials or media, for example, while others focus on specific situations such as distressed companies or corporate divestitures. Many are simply generalists that look at a broad spectrum of opportunities across multiple industries and investment strategies. In evaluating an investment opportunity, the sponsor performs detailed due diligence on the target, typically through an organized M&A sale process. Due diligence is the process of learning as much as possible about all aspects of the target, including business, sector, financial, accounting, tax, legal, regulatory, and environmental, to discover or discredit information critical to the sponsor's investment thesis. Sponsors use due diligence findings to develop a financial model and support purchase price assumptions, including a preferred financing structure. Investment banks. Investment banks play a key role in LBOs, both as a provider of financing and as a strategic M&A advisor. Sponsors rely heavily on investment banks to help develop and market an optimal financing structure. They may also engage investment banks as buy-side M&A advisors in return for sourcing deals and for their expertise, relationships, and in-house resources. On the sell side, sponsors typically engage bankers as M&A advisors to market their portfolio companies to prospective buyers through an organized sale process. Investment banks perform thorough due diligence on LBO targets, usually alongside their sponsor clients, and go through an extensive internal credit process in order to validate the target's business plan. They also must gain comfort with the target's ability to service a highly leveraged capital structure, and their ability to market the structure to the appropriate investors. Investment banks work closely with their sponsor clients to determine an appropriate financing structure for a particular transaction. Bank and institutional lenders. These are the capital providers for the bank debt in an LBO financing structure, although there is often overlap between them. Traditional bank lenders provide capital for revolvers and amortizing term loans, while institutional lenders provide capital for longer tenured, limited amortization term loans. Bank lenders typically consist of commercial banks, savings and loan institutions, and the investment banks serving as arrangers. Like investment banks, lenders perform due diligence and undergo an internal credit process before participating in an LBO financing. This involves analyzing the target's business and credit profile, with a focus on projected cash flow generation and credit statistics, to gain comfort that they will receive full future interest payments and principal repayment at maturity. Lenders also look to mitigate downside risk by requiring covenants and collateral coverage. Bond investors. Bond investors are the purchasers of the high-yield bonds issued as part of the LBO financing structure. They generally include high-yield mutual funds, hedge funds, pension funds, and distressed debt funds, as part of their investment assessment and decision-making process. Bond investors attend one-on-one meetings, known as roadshow presentations, during which senior executives present the investment merits of the company and the proposed transaction. A roadshow is typically a 1 to 2 week process, where bankers from the lead underwriting institution accompany the target's management on meetings with potential investors. Target management. Management plays a crucial role in the marketing of the target to potential buyers, working closely with the bankers on the preparation of marketing materials and financial information. Management also serves as the primary face of the company and must articulate the investment merits of the transaction to these constituents. Consequently, in an LBO, a strong management team can create tangible value by driving favorable financing terms and pricing, as well as providing sponsors with comfort to stretch on valuation.